Hi friends, welcome to my channel. This is Professor C. A. Sandeep Neve, and thank you for subscribing to my channel. And friends, if you're not done yet, kindly do so and share with all your friends who have been embarking on the journey of becoming a chartered accountant. So over the last few lectures, we have been discussing about various types of ratios. We have discussed P&L ratios. We have also discussed balance sheet ratios. So today we are going to talk about discussing mixed ratios, okay, or also known as what? Combined ratios. We all know that the ratios are a very important tool in doing financial analysis. Nowadays, everybody wants to invest in the share market and make a fortune, isn't it? And there you must be seeing that people talk a lot about fundamental analysis. And during that fundamental analysis, the inevitable part of it is this nothing but the ratios. So everybody wants to know about what is this returns on capital employed, what is this returns on equity, and probably that is the thing that I plan to discuss today with you guys. Okay, so let's start. So today we first aim to discuss profitability ratios in relation to investment. Okay, guys, see, pay attention. What we are going to compare? We are going to compare our profitability with respect to our investment. So as we all say, what is the POV? What is the point of view? That how much you have invested in your business, right? How much you have invested in your business and how much profits you are making out. Okay, friends? Yes, we are going to discuss them very fast. But before we start discussing, we have to be very clear about some terminologies in the income statement. Yes, you have to wait for a few moments to get a grasp of all those ratios. Only after doing the income statement will be able to understand how the particular ratios are derived at. What is the logic? See, after you listen to this class, no, you will not have to by heart or mug up the ratios. They just come by logic, simple logic. Okay, let's see. Let's see. It's very interesting. So start with sales. Obviously, we deduct from that cost of goods sold and we arrive at what? Yes, everybody knows that, sir. We arrive at gross profit. Perfect. Now, from gross profit, what you deduct is all operating expenses, correct? And then you arrive at operating profit if, listen to me very carefully, if non-operating income and non-operating expenses are not given, then this itself is our EBIT. What is EBIT? Earning before interest and taxes. Correct, friends? From this, what we deduct is our interest expenses. After deducting interest expenses, what we get is EBT because it was earlier earning before interest and tax. No, now from that interest has been already paid, deducted. So it's EBT. What is that? Earning before tax, which you can also call as what? NPBT. Correct, friends? From NPBT, what we deduct? We deduct tax. That is provision for tax. Obviously, what we are left with will be EAT. Don't think about eat. EAT is what? Earnings after tax. And then from NPBT, obviously, you deduct tax, then it will be NPAT, net profits after tax. Now, from net profits after tax, who will be enjoying these profits? But obviously, sir, all the taxes are paid, all expenses are paid. Shareholders will enjoy. Very true. But in that also, specifically, the first preference, as the name suggests, my friends, first preference will be given to preference shareholders, right, people? So less what? preference dividend. Once the preference dividend is distributed to all the preference shareholders, then the leftover profit, the residual profit will definitely belong to whom? It will definitely belong to equity shareholders. And that's why we call it profits available for equity shareholders. Got it, friends? The sequence to understand this income statement sequence is really very important. So let's quickly take a review. From sales, we deduct first what? COGS. Then we are left with gross profit. From that, we deduct what? Operating expenses. Then we are left with what? EBIT. From that, we deduct what? Interest. Then we are left with what? EBT. From EBT, we deduct tax. Then we are left with EAT, earnings after tax, from which we deduct what? Preference dividend. So the left out profit is profits available for equity shareholders. Now you would say, sir, why are you telling us this statement? Guys, this statement is a guiding light to understand all these profitability ratios in relation to investment. So now you tell me the biggest amount that you invest in your business. Capital employed, very simple. The biggest amount that you invest in your business, the full amount that you invest in a business is what? Capital employed. Capital employed is a mix of both the things, isn't it? Debt plus equity. Capital employed is a mix of both the things. Debt plus equity. As I always tell you, how would you finance your business? Simple, man. The ways are very simple. Either you'll use your own funds or you'll use somebody else's funds. Somebody else's funds means only debt. So what is capital employed? It is debt plus equity. So the very first formula that we discussed now is returns on capital employed. Returns on what? Capital employed. See, I have always tried my best to give you some idea so that you can remember the ratio from its name, isn't it? So what is the first word, guys? Returns. Okay. What is the second word? Capital employed. By now, all my smart students must have understood what am I going to do. Correct? Returns above, capital employed below. Is it not? The first word in the numerator, the second word in the denominator. And see, whenever your examiner is asking you, if you are appearing exam, and the examiner asks you returns on capital employed, you know, guys, what? 50% answer he's only giving you, isn't it? Because he is asking you returns on capital employed. So we don't have to think even twice. We already know what is going to be the denominator of this ratio. Yes, correct. It is bound to be what? It is bound to be capital employed. Now, very important. What should be the returns over here? Returns means profits. Returns means what? Profits. Now, see, I have a choice of profits to do from. I have gross profit. I have EBIT, I have NPBT, I have NPAT, and I have profits available for equity shareholders. Yes, one of this is going to come over there. Let us identify. Okay, what profit will be available for all the capital employed? Capital employed means what? Debt plus equity. Equity will be always including preference also. Now, if you observe properly, not this, correct? So from gross profit, first you'll deduct what? Operating expenses. You can't start paying interest, preference dividend, equity dividend. Okay, chalo. Let me do one thing. Let me mark that also. Interest, preference dividend. And then Payesh we have, obviously, Payesh means I mean to say profits available for equity shareholder. Shortcut, Payesh. Okay. Yeah. So from which we will pay equity dividend, isn't it? So guys, tell me, for returns on capital employed, is a gross profit suitable profit? No, sir. Is EBIT suitable profit? Yes, sir. Because from EBIT, look at these green flags, interest, preference, and from this page, I'll pay equity dividend. So it is that EBIT, the profit, EBIT is that profit from which I'll start making payment to all my stakeholders. Isn't it? Denominator would be capital employed. That's why. But in the numerator, what am I going to write? EBIT, and the formula is done, guys. Simple, returns on capital employed. So denominator is bound to be what? Capital employed. Which profit is most suitable for capital employed? EBIT, because from this profit you start making payment of interest, preference dividend, and from pay you will pay what? Equity dividend. Understood, friends? It is very logical. I'm very sure after this, no, you don't have to buy this formula. Returns on capital employed. The moment anybody says no, you know half the answer. Denominator is fixed. What is that? Capital employed. Numerator, you need to think, okay, what is the best profit from where I start making payment of all these people? It is EBIT. That simple, guys. Okay. Now, let's proceed further. Let's take number two, returns on proprietors funds. I can feel it, guys. You have already guessed half of the ratio, isn't it? No, returns on proprietor funds. So numerator, some kind of returns have to come. Correct, friends? Okay. And in the denominator, now everybody knows what is going to come. Proprietor fund. Half the formula done, guys. Half the formula, so already you have only decided in your mind. So, chalo, let's write in the same fashion. Denominator is going to be what? Proprietors funds. Proprietors funds includes equity capital, preference capital, reserves and surplus, and minus miscellaneous expenses. Now, come on, smart students are going to tell me you can quickly guess what is going to be the numerator. See, proprietor funds means payment, that profit from where payment of preference and equity starts. And you already know it. I hope you know it. What is that profit? NPAT, isn't it? See, from NPAT, we make a payment of preference dividend. So we are left with PAISH, profits available for equity shareholders, from which we will deduct what, or we will pay what? We will pay equity dividend to all our equity stakeholders. Isn't it? It is so simple, guys. So what will be the numerator? The numerator is bound to be NPAT. Got it? Got it till here? Okay. Let's go ahead with the third one now. So third one is returns on equity shareholders funds, also known as returns on equity. Also known as what? Returns on equity. Fine. Now, half the people have already decided what is going to be the formula. Come on, people, pay attention over here. Returns on equity shareholder fund. So denominator, everybody now knows is going to be what? Sir, we have already devised what is going to be the numerator. Okay, friends, 1 minute. Let me write equity shareholders funds. So people, now in this income statement, I told you know that income statement is very important for understanding this formula. Come on. Tell me which is the most eligible profit to pay dividend to the equity shareholders, and everybody knows the answer, sir. It is PAISH. Profits available for equity shareholders. So guys, returns on equity formula is very simple. Dash 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 upon equity shareholder fund. What that dash 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 will substitute by? Will put by profits available for equity shareholder. Guys, see, this way if we learn, it goes so simple. You don't have to buy at the formula. You don't have to mug up the formula. It comes simply by logic. Isn't it helpful, guys? Okay. Ours is a aim, right? Let's share the knowledge and let's grow together, isn't it? Chalo, we'll embark on this journey. Last, let's go with the last one. Returns on equity share capital. Yes, I know that you know the answer, right, people? Yeah, it is very simple. Now you have to compare the returns with that of what? Equity share capital, right, friends? Okay. So you know what is going to be the denominator. Perfect, guys. Returns is the first word, isn't it? Equity share capital is the second word. So what is going to be in the denominator? Equity share capital. Correct. So here we'll write equity share capital. So people, numerator will not change. Earlier also it was Payesh. Now also it would be Payesh only. Profits available for equity shareholders. Isn't it very simple? See, if you find this useful, I'll request you once again subscribe to my channel and share it with all your friends doing CA, CS who need to learn simple logics and they need some guidance for financial management. Okay. So, what is the difference between these two ratios, guys? Nothing. It is returns on equity shareholder fund. Here you take equity capital plus reserves minus miscellaneous expenses, and here you just consider the equity share capital amount and find out the profits on it, find out the profitability on it. Understood, friends? Simple, done. Now nothing else left because the income statement is over, isn't it? This is what the profitability ratios in relation to what? In relation to investment. We have made it very simple. How many ratios? Tell me, guys, how many ratios? Four ratios. The first one is returns on capital employed, and the formula is what? EBIT upon capital employed. The second one is what? Returns on proprietors fund, and what is the formula? The formula is MPAT upon proprietor fund. Third one is what? Returns on equity shareholder fund, and the formula is what? Payesh, profits available for equity shareholders divided by equity shareholders funds. And the last one is returns on equity share capital, which is again Payesh only but divided by equity share capital. I suppose that this was very helpful to all of you. I'm bringing everything on one page. So in case you need to take a screenshot, keep it with you, share with your friends. You can do that by taking a screenshot. Thank you. Thank you so much, friends. I hope you have liked this session. And I'm very sure that you must have understood this concept. I once again request you subscribe to my channel, share with your friends. Let's share the knowledge and let's grow together. Thank you so much.